Welcome to this video on understanding mean value gaps, or MVGs, brought to you by TradeHive. In execution terms, an MVG is the equilibrium between two imbalances, often two fair value gaps, or FVGs. Think of it as the price where trading should happen if the auction is fair. MVGs matter because algorithms prioritize efficiency, even if markets don't trade fair immediately. Do MVGs get filled? Yes, but it is conditional and not guaranteed. High probability fills, ranging from 70 to 85%, occur when the MVG is aligned with the higher timeframe bias created by strong displacement and is located inside or near a premium or discount. MVGs with a moderate probability, 50 to 65%, are often countertrend, mid-range without high timeframe context, or occur late in a session. Low probability MVGs below 40% form during news spikes, in parabolic moves, or are invalidated by a change of character. These often remain untouched. The key truth most traders miss is that MVGs are not trade signals, they are magnets. Timing still matters. Price often tags part of the MVG, reacts, leaves a portion unfilled, and returns later. This is algorithmic pacing, not failure. The number one rule for using MVGs profitably is to use them as targets, context, and confluence, not as entry signals, bias, or confirmation. Your execution should be based on factors like BOS, Choshi, liquidity sweep, CVD, or session timing. Institutions don't say, price must fill this MVG. They say, if price wants efficiency, this is the most probable path. Understanding this distinction can help you avoid bad trades. Not all MVGs are equal. Institutions mentally rank them based on fill priority. This hierarchy matters for your trading decisions. Tier 1, or must-respect MVGs, have the highest priority and about a 75 to 85% fill probability. They pull the price, are aligned with high timeframe bias, created by strong displacement, and are the primary efficiency objective for institutions. Tier 2, conditional MVGs, have a 55 to 65% fill probability and are context-dependent. They are secondary efficiency objectives and often fill partially first or after a liquidity sweep. Tier 3, informational MVGs, have a 25 to 40% fill probability. They are diagnostic, not wrong. They often occur during news spikes or after a major liquidity objective is hit, confirming strength or imbalance dominance. The institutional ranking shortcut involves 5 elements: bias, liquidity, displacement, location, and session. If an MVG fails any 2 of these, you should downgrade it a tier. For your trading, translate MVGs specifically. Tier 1 MVGs are targets. Tier 2 MVGs are conditional targets after structure. Tier 3 MVGs should be used as confirmation, not faded. This prevents forcing counter-trend trades. In plain English, an FVG is a single imbalance showing inefficiency, defined by a 3-candle structure. An MVG is the equilibrium or mean between 2 inefficiencies derived from imbalances, not drawn independently. To calculate the MVG, take the high of the lower imbalance and the low of the upper imbalance. The midpoint between them is the MVG. This zone is where the price is most likely to react. The easiest way to calculate the mean is using your Fibonacci toolset to 0 minus 50% to 100%. Draw it from the high of the lower imbalance to the low of the upper imbalance. The 50% midpoint is the MVG.